Index funds are a portfolio of multiple stocks and bonds. The goal of these funds is to try and mimic the composition and performance of the overall stock market. Let's say that you were to invest in an index fund that replicates the S&P 500. Your investment would closely follow the performance and composition of the S&P 500, meaning you get the same returns as the index, as well as technically owning the companies that make up the S&P. Essentially, the theory is based on the assumption that the overall market would outperform any single asset in the long run. Let's talk about the pros and cons of index funds. Index funds are safe investments that outperform 99% of actively managed mutual funds due to their inherent diversification feature. Even though one stock in the index fund might have a massive drop, the other assets within the fund would compensate for the loss with their own gain. This gives investors a nice cushion that helps them reap the returns of the overall market, but at the same time protects themselves from the risk of a single asset failing. Another benefit to investing in index funds is that they're generally considered passive investments. Rather than worry about the fundamentals of a company, whether it be the earnings report soon to be released or negative news that could fluctuate the price of a stock, index funds are investments that are generally to be bought and forgotten. One disadvantage to index funds is that they generally have limited gains. So while one stock within the index fund might grow massively, there might be 10 other stocks losing that can bring it down. Also, because index funds follow the general market that it tries to replicate, it is susceptible to market cycles, meaning that when markets are down, index funds are down as well. The top 3 index funds are the SPY, QQQ, and VTI. The SPY and QQQ are ETFs, which, unlike index funds, can be traded throughout the day. The SPY is a fund that tracks the Standard & Poor's 500 index, or in other words, the S&P 500. It consists of the top 500 large and mid-cap stocks in the US stock market, making it one of the most diversified funds of the bunch. Let's talk about QQQ. QQQ is a fund that is based on the NASDAQ 100. While it isn't as broad as the SPY, it's a fund that is very tech-intensive, which drives the entire market as a whole. It can be reasonably said that when the market as a whole is flourishing, QQQ would return the most out of the bunch. However, at the same time, if the market is collapsing, QQQ would lose the most. Lastly, VTI is a fund that is very similar to the SPY. It is a fund managed by Vanguard, a very reputable investment firm. One of the biggest upsides to VTI is that it's the most diversified out of the bunch, comparing the SPY's 500 stocks versus the VTI's 4,000 stocks. So while the SPY and VTI might have a similar return, you're more diversified holding VTI. With that being said, if you liked the video, hit the like and subscribe button and have a wonderful day.